Welcome back. We are here with Michael Craig, Head of Asset Allocation at TD Asset Management. We're going to turn our attention from talking about just what's been driving the markets recently to more what do you do about it. And so how should investors be approaching this market right now?
So first off, whenever I get asked that question, it's always what you're trying to accomplish. What's your time horizon? If you need your wealth or your capital next year, that's one thing. If you need it in 30 years, that's a whole other. But from a more kind of here and now tactical basis, I would say the following. First, on the fixed income side, it has been a challenging year. It's been a challenging 2 years. And much of this has been repricing after COVID. It's been moving to quantitative tightening from quantitative easing. It's been this blast of inflation we had post-COVID. But if we sit right now and look at the bond market, it is showing valuations that are as cheap as they've been since the early 2000s. Mm-hmm. So you're kind of going back 20 years where it was this attractive. And when you're earning yields north of expected inflation by 2.5%, it's a pretty good value. So it's a little bit like catching a knife. It has been selling off precipitously, but I think for people who have a bit of a longer term horizon, a week or two, it offers tremendous value. In terms of the equity space, here I'd be a little bit, the world's getting a bit messier, and in many ways, if you think about where the most attractive market is right now in terms of productivity and in terms of capital, return on investment capital, you are looking at the U.S. market, mm-hmm. right? So there are some arguments it's a little bit pricey, but it's nowhere near kind of bubble formations, and that's where you're going to get the best growth. So we still kind of like the U.S. market. And I think if you're a global investor thinking about places where you're going to send money, that still is probably the market you want to go. In Canada, it's been a bit of a soft year. I do think that this rate hike cycle is going to have a materially more significant effect on the Canadian economy than the U.S. economy. So I'd be a little bit lukewarm on the Canadian economy. You do get the energy complex, which is mm-hmm. interesting, but banks have not traded tremendously well, both U.S. and Canadian banks, and so it's an area where I think again valuations are pretty attractive, but you do want to see this hiking cycle pass and make sure you don't have any type of credit event. And then I think that the Canadian bank side looks quite interesting in terms of that. But you do got to get through this period where you're probably going to have some charge-offs from bad loans. Yeah,
and the alts in the private space?
Yeah, in the private space, we love infrastructure. This is where you're seeing, in terms of kind of the green transition, or whether it be new types of infrastructure to deal with hotter climates or renewables, et cetera, a tremendously interesting area to invest in. On the real estate side, not all real estate is the same. On the office space, it's a bit tough right now. But on the industrial distribution center, multi-residential apartment, very strong demand, strong pricing. So, in terms of a portfolio diversifier, phenomenal. And I would be remiss not to mention commodities, mm-hmm. an area that we've now entered into that market. We think that when you think about what's needed in terms of infrastructure and, basically rewiring our economy to get away from carbon, and the commodities required and the lack of investment in commodities, the only way to kind of resolve all this is to see higher prices. And so we really like commodities as a diversifier and also a place to make return within an overall portfolio. So that's kind of a thematic, 5-10 year view. Yeah. But I think that's going to be not unlike the first decade of the century. I think we're going to see another type of super cycle in the commodity markets.
Yeah, and I think you say about those the building for decarbonization, the reshoring, even the geopolitical stuff is just kind of, it seems like it's kind of all moving in the right direction, or I should say the same direction.
Absolutely. The tragedy that's happening in the Middle East, the tragedy that's happening in Ukraine, these are unfortunately, these are typically things that are going to put a bid in for commodities just because it's making the ability to trade globally that much more challenging.
Yeah, lots of attention, being paid to GICs. They're simple to understand. Mm-hmm. You get them, you get the return, you see it there. But there are some risks investors need to think about with this too. Yeah, the GIC rates really will mirror what fixed income rates look like. So, GIC you're playing for a couple of years, you're getting a similar kind of a yield in the bond market. I would say for near-term investments, they're absolutely perfect. Like if your child's going to university next year, which I'm thinking about myself, GICs make a ton of sense. You need that money in 12 months' time. You're going to get there's no risk, if you will, to what you're going to get back. So perfect. But if in terms of building wealth, I would say that over time, they've shown to not really be helpful there. They tend to earn less than inflation, although right now is a bit of an anomaly. And I would think if you're an income type of investor, in the fixed income space, you're getting a similar yield. So the yield stream is not too dissimilar.
And you do have the opportunity for that capital gain if rates start to normalize, right? So there is this lift from not only just the income, but also the capital, and it's more tax efficient. So those are some things to think about if you're looking at income solutions.
Michael, always a pleasure. Thanks so much.
My pleasure. Thanks for having me.
Michael Craig, Head of Asset Allocation at TD Asset Management. Up next, you've been living overseas and now you want to come to Canada. Nicole Ewing of TD Wealth is going to tell us what we need to know, especially from a tax perspective.